There was some thinking during the Clinton administration in the U.S. that if you gave people more affordable mortgages, they'd move into better neighborhoods, and that would also mean better schools because more real estate taxes go to the schools for better schools. But that didn't turn out to be the case, and that's according to some new research by INSEAD Assistant Professor of Economics, Amin Wazad, who is joining us now. Welcome to INSEAD Knowledge.
Thank you.
What was the basis behind this report? Are you looking at credit and mortgages, or are you looking at racial integration?
We want to look at the effect of the credit supply by banks, lenders in general, on segregation, racial segregation. That is, whether more credit led to more racial integration in cities in the U.S. over the period of the credit boom, which is 95 to 2004. You know that there has been a lot of intervention in the mortgage market by the federal government, by subprime lenders, by independent mortgage brokers. You know, there was like this kind of like far-reaching political statement saying we are going to give hope to people by providing credit, and they're going to move to better neighborhoods, and we will have better neighborhoods, more integrated communities, and all is well. We wanted to test that, and we gathered 12 years of data, 80 to 90% of mortgages in the U.S., with the characteristics of the mortgages, you know, the amount of the loan, where the house is located, and we matched that to neighborhoods and schools. All schools in the U.S., private and public,
throughout the entire,
years.
all 50 states, or just the continental U.S.?
Over the entire 50 states.
And which were the 12 years that you looked at?
95 to 2007. So we have the credit boom, 95, 2004, and then we have some small chunk of the crisis. But the crisis is another story. The most important story is the increase in Hispanic population over the period. We have doubling of the Hispanic population as a fraction of U.S. population over the 1990-2000 decade. Where do Hispanic migrants go? And do families move to better neighborhoods? Do they use credit to move to better neighborhoods?
And did they?
Well, what happened is that Hispanic families, Hispanic households, tended to use credit to move either to Hispanic areas or to white areas. And they tended to avoid neighborhoods where there's a large fraction of African Americans. And so they use this credit to do that. I'm not saying the story is racial here. Because
that does sound sort of racial. I mean, it's hard to, one thinks of African American neighborhoods as not being the best. And if you were an Hispanic who just moved into the U.S., you'd be wanting to probably not be in that kind of a neighborhood.
That's right. So it's not per se about race. It's about the fact that households may want to move to better neighborhoods. And this is strongly correlated, unfortunately, in the U.S. with race. By many metrics, education, income, crime rates, African American neighborhoods tend to be the worst neighborhoods.
How is all this related to the U.S. Jim Crow decision on segregation in the schools that allowed for school busing to achieve segregation? I mean, this was before anybody thought of cheap mortgages.
So the so-called Jim Crow laws, which were state-level laws, were meant to segregate by law African Americans. And before the civil rights movement, most of the racial segregation was actually enforced by either municipalities, states, or just through racial covenants on the deeds of houses that prevented the sale to minorities. After the civil rights movement, what happened is that there was no more legal enforcement of segregation, and so that's the market that started pricing out minorities from more white neighborhoods. So then the market basically partly was a substitute for these laws, unfortunately. So. The thing is that mortgage supply was tightly regulated until the Reagan years, where you had interest rates shooting up, deregulation of the banking system that planted the seeds of the current crisis and also of the previous boom. And what we see is that, again, the market has played the role of segregating households. And this time, it's not the housing market, but the mortgage market. And
as prices kept going up, I mean, it costs more and more to get into a better neighborhood, too. So it didn't really matter. You were just still excluded, but at a higher price.
But it affected whites and Hispanics and African Americans differently, because when the prices shoot up, it's only the high-income individuals who can keep the pace of the price increases. And the minority households tend to be priced out. Whereas the increase in credit supply tends to benefit more low-income households. So we see like very different dynamics in this constrained cities than in the cities where the supply of housing can freely expand, like Austin, Texas. So they're very different dynamics, but overall, what we show in the study is that more credit supply increased segregation.